Well, hello everyone and welcome to another of the TradeStation webinar series. Today we welcome Dan Sheridan, the CEO of Sheridan's Option Mentoring Service. Dan Sheridan is the founder of the Sheridan Options Mentoring Service. He has over 25 years, maybe longer, of experience trading options and educating traders worldwide. I noticed a number of you are from around the world, and so welcome to Chicago, where we talk about options a lot. Today we're going to talk about the Greeks of weekly trades. But before we get into our options presentation today, we want to talk about the risk disclosure documents that are available to you in the chat panel. They're also available on the TradeStation website. Our presentation is for educational purposes only. All the symbols and the trading ideas that we discuss here are for demonstration purposes. They are not recommendations. This presentation is not an offer or a solicitation of any kind in any jurisdiction where a TradeStation affiliate is not authorized to do business. Active trading may not be suitable for you simply because active trading is not suitable for everyone. Options trading does carry a high degree of risk and may not be suitable for all traders. As I said, that disclosure information is available in the chat panel. Now, which brings me to the star of our show today, Mr. Dan Sheridan. He's a veteran CBOE market maker, and he's worked with the highly successful specialist firm Mercury Trading. Dan was responsible for training almost all the traders at that firm, including Pete Najarian, one of the current hosts of CNBC's Fast Money. Dan left the pits in 2004 and founded Sheridan Mentoring. He now teaches individual traders the techniques and the methods he used every day to consistently profit in options markets. Today he wants to talk to us about how to take care of Greeks in those weekly trades. Dan, welcome to TradeStation.
All right, welcome, Don. Hello, everybody. Welcome. Glad you're here. I see a few people from Europe or time zones that are they should be going to bed pretty soon, but glad to have you here. And today we're just going to go over a few strategies, talk the Greeks, help you get a little bit more familiar with Greeks, that you understand a little better what you're doing. Again, my goal is that you spend more time learning the craft and less time worrying about things you can't control, like which way the market's going. So let's jump in here today, and we'll go through these slides. All right, first thing I just want to get this out of the way because I'll forget, but just to give you a couple free things that I'll do this at the beginning because it's easier so that we can just stick with these webinar. If you notice here, there's a couple free webinars that we are going to be doing in the next 2 weeks. And you can see here Wednesday, April 26th, we're past February. I'm going to be doing, I'll talk about this a little bit today, but this all put flat fly butterfly, which is an out of the money put broken wing butterfly. It's been one of the more successful trades in our community the last couple of years. And I'm going to have, we have a free webinar on it, and this is Wednesday, April 26th. So if you want, I might just do it. It'll be recorded, but you need to, if you just go to somurl.com/butterfly, you can do that real quick and just put all you're doing is putting your name and email, and we will get you, make sure that even if you can't make it live at 1 p.m. Central on Wednesday, April 26th, we will send you the recording. And the other one, Tuesday, May 30th, we're going to have Mark Fenton, who works with me, is really good with options on futures. And he's been trading the crude oil, the E-minis, the bonds, and soybeans a lot over the last 4 or 5 months. And he's going to be sharing what he's been doing on that. So and that's somurl.com/futures. If you want to just type that in real quick, get it over with. That way you at least get the recording. The only other thing to let you know about, this one's actually a little bit of money. The other two are free. It would get you used to what we're doing. The other one that's little more money, but it's well worth it. Don Prattle was there last year with TradeStation. It's a 2-day live Chicago seminar we do every year. We call it our annual reunion that we do at Sheridan Mentoring. It's in Chicago, June 15 and 16. We'll have 12 veteran traders, people in the top names in the industry, some of our top students, and sharing with you how they trade to make money. And it's at the beautiful Chicago Gleacher Center in downtown Chicago. And it's $447 for the event, which is extremely reasonable. We about break even. We just do this for our community, but anybody can come. And included in the price, you get all the PowerPoints for the 12 speakers, lunch each day, drinks all day, and it's just a great seminar. We do a boat cruise on Thursday night. And so anyways, just wanted to let you know about that. That's about all I have to give you guys information on. All right. Let's, again, I encourage you to type in those URLs. Again, the butterfly one is somurl.com/butterfly. And the futures options is somurl.com/futures. All right. So let's dive in, folks, to the presentation for today. And we're going to talk about 5 things today. We're going to talk about a 15-day SPX call credit spread, a 36-day SPX put credit spread, so to address credit spreads. I think that'd be easier to address than a 3 or 4-legged animal like an iron condor or a butterfly right off the bat. Then I'm going to talk about I think a pretty relevant topic right now, put insurance for black swans. What if there was a big move in the market? What if there was a 10 or 20% move? What do? I mean, we've got, we kind of threw some missiles at Syria. We've got an unstable North Korea going on. We've got a lot of interesting things, and the fact that we're 40 points after the big rally in the U.S. market today. We're 40 points off the all-time high, and we're due for a correction, right? So are you thinking about, well, what about some put insurance? What if something crazy happened? Or on some of the trades I have on, maybe some of the positions I have on, can I buy a little bit of insurance? And so I'm just going to talk a little bit about put insurance and some of the some of the pluses and minuses of put insurance. I think that could save you a lot of heartache. I think that's important. And then we're going to finish off on a 36-day at the money broken wing iron butterfly. And these are some of the more popular income spreads we do for monthly income in our community. And then this one, we'll just at least introduce it today. This is going to be the topic of one of the free webinars that was on those links. And if you missed those links, I don't know if my nephew John is watching this. He could type those in, or I think Don is going to have he'll have the presentation slides, or you can email me, either way. But this is the one we're going to be doing on the presentation. All right. So first of all, I took these graphs today, and as you can see, here's a graph of SPX. We'll start with SPX. And you could see we've been basically trending up for the whole year. What's interesting is, the last 2 months of the market have been pretty good. The last month of the market, SPX has been in a 59-point range, which is pretty good, right? For a vehicle that I think today's trading, I don't know where SPX closed, but let's just throw this in there somewhere around 23.55, right? somewhere around there. But the 1 month range has been 23.22, 23.81, 59-point range. The 2 month range has been 23.22 to 2400, about 78 points. So you say, what does that mean, Dan? That the last 2 months have been in that kind of range. That means it's kind of good sideways, good for income trading, range-bound strategies, right? And really, 2017 hasn't been bad. 2017, the last 4 months, we've had about 155-point range in the market, 2245 to 2400. But let's face it, the last 4 years we've been going one way, right? So for people doing covered writes, cash secured puts, bullish strategies, it's been like happy days are here again, right? All right. Here's a VIX, 1 year VIX chart. And one thing to keep in mind with the VIX chart, for most of the year, most of the last year, we haven't really had volatility going up that much. Excuse the, whoops, I'm not sure how I did that. Let's see. I don't want it running continually. Let's see. 1 second here. It's like the annotation has gone haywire. Just trying to, I'm not sure what's going on here with this annotation. It's like going wherever I move the cursor. Let me just see here. No, I am not. I am not sure here. Here, 1 second. We'll figure this out. But let me get my, as I'm talking here, I'll get my nephew who works with me. What's that? Hey, Jack? I'll have him work on that. But the main thing is we've had basically a low volatility environment over the last 1 to 4 years, and we've had an upward moving market. I'm trying to get, see, I can't even move this. It's like all over the place. So that's kind of the setting that we've had in the market over the last year. Yeah,
it's glitched out.
Yeah. So if we can go to, okay. Yeah. Now if I do that again with that thing, will it go crazy? Let's see.
Maybe click on it again. The blue pencil. Yep.
All right. If I just write. Okay. I think it's behaving now. Good. All right. So here's an example of a 15-day SPX call credit spread. And so let's run through this and we'll talk the Greek. So here's an example I took with SPX at 2344 today. I think we closed higher. And with SPX at 2344, I was looking at a 15-day SPX call credit spread. And so with SPX at 2344, I sold one May 5 expiration. That's 15 days from today. 2380 call. And I bought one May 5 2390 call. I chose the short strike. I sold a delta of 23 for the short strike. So again, SPX was at 2344 today. And I sold the 2380 calls, 36 points out of the money. And they had a delta of 23. So what do you think a delta of 23 means? What does it mean to you guys? What does it mean to you guys that if I choose a short strike with a delta of 23? Again, this is my expirations May 5, 15 days out. What does that mean? Anybody? Give me a short. What does that mean? I sold a 23 delta call. Does that mean anything to you? Does that mean anything at all? Here's where the price was at the time, 23.44, and I sold the short strike here This is the expiration graph, this red graph. This purple graph is the graph of the position today. But what does that mean? Does anybody know? If I sell a 23 delta call, yeah, it just means there's only a 23% probability in the next 15 days that we're going to finish over 2380. Right? So we're at 2344 right now. I sold the 2380 calls and basically bought the 2390 calls for just protection, right? I don't want to sell a naked option because it will cost me a lot of money in margin. So if I sell this 10-point credit spread, I bought the 2390, sold the 2380, it's a 10-point call credit spread for $2.45 credit. And it's basically saying, if you take 100 minus 23, there's a 77% probability at expiration we're going to make that credit, right? So 77% probability in the next 15 days, the life of this trade, I'm going to make my credit of $245. Now, how much capital does it take for this trade? The capital is $755. How did I get that? Just take the difference between the strikes is 10 of the credit spread. And so it's $1,000. $1,000 of risk if SPX goes up to $1 million. $1,000 of risk less a credit of $245 gives me a margin or total risk of the trade of $755. Again, this is your expiration graph. How the graph looks at expiration, which is 15 days. This graph here is how, if I put it on today, how the graph would look today when I put it on. And so the expiration graph, right? This is your zero line, and this is plus P&L. This is minus P&L. And so if I made the entire credit of $755, if I made the entire credit of $245 on one contract divided by a margin of $755, that's about a 32% return over the 15 days, right? Yeah, it is an accurate, it's pretty accurate. You know, again, we could get anal about the math, but that's pretty good. That is it. Now, let me, you know what, I may not use the annotation anymore. I think I may have my nephew, just for whatever reason, I'm having trouble with, I use WebEx every day. And so this is, I think what I'm going to do, because I annotated this pretty good. I've given you you can see everything loud and clear. I think what I'm going to do is just get this fixed here and then keep going. Okay? Danny. I know. Yeah, I will not use annotation anymore. So this is a call credit spread, and you guys could follow me as we're going here. Okay. Johnny, okay, we need to go back here because we're doing that. This is what I'm doing right now. I'm not done with. Let's get rid of this. Maybe we can't. It's all right. Just trying to get rid of this scribbling. We can't get rid of it. Okay, I will not use this anymore today. This is not my day for using this annotation. All right. Now, so if you look at this position, it's a little scribbly. Has anybody ever done in here a call credit spread? How many of you have done a call credit spread? How many of you have done a call credit spread? Anybody? Anybody in here ever done a call credit spread? All right, quite a few of you. Now, why don't we just go to the next one, because that, I mean, it's all going to be work well. So here's an example of a 36-day SPX put credit spread, right? Call credit spread, put credit spread. Here's one on the put side, and we'll focus on the Greeks a little bit. I will not touch the annotation. In this example, I'm selling one with SPX at 23.45 today, a little bit earlier in the day, selling one May 26, 23.55 put, and buying one May 26, 22.45 put. So we're 36 days from expiration. I'm bringing in a credit of $1.25. My margin or risk is $8.75. That's the difference. How did I get the margin or risk of $8.75? The difference between my short put and long put is $10. So I have $1,000 of risk per credit spread, less the credit of $125. So for every one contract, I have $875 of margin of risk. So the way I do it is, if I say I'm looking to make 10% on this credit spread, what would be the answer? What would you say if somebody said to you, we're trying to make 10% on this credit spread? What answer would you give them? What answer would you give them if someone asked you, I'm looking to make 10%? So the red 23.45 is the current price, which I took the slide. That's where SPX was trading at. And we're selling the we're selling the 23.55 puts. Wait, did I write this down wrong? You know what? I apologize. The Greeks and everything are right. I just wrote the wrong strikes here. So I'm going to try to, this could be dangerous, but this is not, I just made it, usually I catch my things. This was the 22.55 put. This was the 22.55 put. All right. And here we go, guys. I sold the 22.55 put. I bought the 22.45 put. Okay. So I just wrote the strikes down. So I'm selling the short put 100 points out of the money. I'm selling the 22.45 put, and I'm buying the I'm selling the 22.55 puts, buying the 22.45 puts, 100 points out of the money. And so I'm doing a put credit spread 100 points out of the money. The delta of the short put is about 20. So there's an 80% probability that over the next 36 days, SPX is not going to go under the short strike of 22.55. So again, SPX is at 23.45. I'm selling the 22.55 put. I'm buying the 22.45 put. So I'm 100 points away. I'm selling a 20 delta, basically a 20 delta for the short put. And so that means it's an 80% probability that I'm going to get my whole credit of $1.25 at expiration. It's part of the story. The deltas of this position are 1.85 long for every one contract. My gamma is minus 0.02, my theta is 1.34, and the Vega is minus 11.90. So that's a put credit spread. Now, have put credit spreads worked real well over the last 2, 3, 4 years? What do you think? Have put credit spreads worked really well over the last 3, 4 years? Yeah, I've got people in my community that have done put credit spreads for 3, 4 years, and and barely lost, right? Jack says the premium is outlandish in real time. I'm not sure what that means, but these were real prices taking $1.25 credit, and that's pretty normal. For a 20 delta put credit spread 36 days out in SPX, about $1.25 of the credit that's pretty normal. Now, let me just tell you something. What do I think is, now Mike says 36 days seems long time for sell in May and go away. Well, let me ask you guys, how many of you, your risk management is put it on, close your eyes, go away, and come back and see what happens? How many of you, that's your risk management style, where you would sell a put credit spread, close your eyes, run away, and then just come back and hope it comes well, right? That's not risk management, right? So here's the key here. First of all, if I'm doing a put credit spread, how will I pick my duration and how will I pick, let's go through some of this, right? So I'll teach you in the next 3 minutes how to run a put credit spread business, right? Which is mainly neutral to bullish, right? So you do one every month and have good probabilities in your favor, right? So how do you do it? So first of all, why do I like SPX? Because SPX is well diversified. Do you agree? There's 500 stocks in SPX. So number one in our put credit spread business, pick SPX. Why? Great liquidity, trades a lot of options. It's well diversified. All right, so I've got my vehicle. Now, what duration do I do? Is there a good duration? Do you think it's better to do put credit spreads 30 days from expiration, 50 days from expiration, 7 days from expiration, 21 days from expiration? Is there a best? Is there a best duration? Now, somebody said, why not an SPY? You can do that, right? You can do SPY, right? It's cheaper, but it's the same product, isn't it? SPX versus SPY. Now, let me ask you, do you believe in your heart of hearts that one duration is better? Do you really believe that? Do you believe that 45 days is better than other durations? Do you believe that 30 days is better or worse than 45? All right. Now, let me just say this. If you ever hear anybody say it's best to do this duration or this strategy is best, run, right? Because there is no best, right? There's pluses and minuses, right? But what are some pluses and minuses of doing a put credit spread 7 days from expiration? What are some pluses of doing a put credit spread 7 days from expiration? What are some pluses of doing a put credit spread 7 days from expiration? The pluses are you make your money really quick, right? You can make a quick profit on a weekly basis. Now, the negative of that is if the price movement moves against you, and since we're talking put credit spreads to the downside, you have more price risk than a longer duration, right? But there's some great advantages to doing 7 days. Now, how about let's go 50 days out or 30 days out on a put credit spread? Now you go further out, you get less daily decay than you do on a 7 day. You don't get hurt as bad on price movement if the SPX goes down, right? You're further out of the money. So there's pluses and minuses. How do I solve that issue, right? How do I solve that issue? I diversify. What do you mean? If I'm going to designate $10,000 or $5,000 to put credit spreads, me personally, I might put 70% of the capital into maybe 30 to 40 days from expiration, and then I might put 30% of the capital into shorter term durations, maybe 7 from 14 days. Okay, so just diversification. There's no best, right? What else? All right, so I told you, I said I was going to give you how to run a put credit spread business. Number one, the vehicle SPX. Number two, we talked about the duration. So 36 days is within the 30 to 40 days. How do I pick a strike? I like to pick around a 20 delta. I could go further out of the money, but I don't get as much. And so I want to get good probabilities, but get something out of it, right? I don't want to do a credit spread for 10 cents. So, but again, remember, if I sell a put at a 20 delta, and I'm doing that every 36 days. And now here's the other thing. Let me ask you a question. They have weekly options. So can I go in every Wednesday or Thursday and put on a 36-day butterfly? Excuse me. Can I go in every Tuesday, Wednesday, or Thursday, either day, pick a day, let's say every Wednesday, and go in SPX and find something pretty close to 36 days and put on a 36-day put credit spread every week? Can I do that? Yeah. So am I diversifying the price risk that way? Yes or no? Am I diversifying my price risk by putting on one 36-day put credit spread every Wednesday? Absolutely. Right? Now, but if I'm doing a 20 delta short put credit spread every week, is it fair if I go to my local Panera Bread for soup at night that I can stand up there and tell everybody I'm doing put credit spreads with an 80% probability of success? Am I allowed to say that at my local Panera Bread? Yes or no? Am I allowed to say that at my local Panera Bread that I'm putting on 80% probability? Yes and no. Yeah, I mean, yes, they are 80%, but here's the reality, folks. Here's the reality. Are you going to do a put credit spread? So in this example, SPX is 23.45. I sell the 22.55 puts, and I buy the 22.45 puts. Let's say tomorrow SPX is down 5% or 100 points. And let's say SPX tomorrow, let's say it goes to 22.70 by my short put. Now it's not through my short put, so at expiration, I would be winning. But let me ask you a question. I'd be down quite a bit of money. How many of you would with a straight face tell your wife or husband at the dinner table, hey, honey, good news and bad news? You know that put credit spread, I sold the puts at a 22.55 strike with SPX at 23.45. Well, SPX was down 60 points today. It's only at 22.65. Here's the good news, honey. The good news is if today were expiration, we'd be a winner. I'd get my whole credit of 125. The bad news, honey, is today is not expiration. We're only one day into a 36-day put credit spread. The reality is that credit spread that we sold for $1.25 is now trading at $7. Right? Could I look my wife in the face and say, honey, that's paper money, don't worry about it? No. Now, Scott's getting a little advanced, and I'm not going to, why wouldn't I fly it off at 22.55? Well, here's the reality. If we went to 22.55 tomorrow, Scott says maybe I can, since I'm selling a put credit spread, buy something against it to hedge it off. Well, here's the problem. If we go to 22.55 tomorrow, you're in a heap of trouble. And in my opinion, it's too late, right? So let me give you, in the next minute, let me give you a risk management plan that'll keep you out of trouble the next 3 years with put credit spreads if you actually pay attention, if you actually do it, right? So here's the key. So what I'm going to go over right now is I'm going to explain to you probably the most important thing in my opinion on running a successful put credit spread or call credit spread business. And the beautiful thing is, even if you're a beginner, in other words, the cooks at Panera Bread could understand right now what I'm telling them, right? So you can't use as an excuse, hey, I don't understand options. I'm not getting into options, right? So if I sell, so let's go over this. Just a simple risk management plan. First of all, if I'm doing put credit spreads or call credit, for me, I'm a big believer, I got to do them every week or every month, over and over and over and over and over. So that's how I do things. But if I'm doing this put credit spread for $1.25, what's my risk if SPX goes to zero? If I do this 10-point put credit spread for $1.25 credit, what's my risk if SPX goes to zero? It's the margin, if it's a 10-point put credit spread, my risk is $1,000 less the credit, or $875, right? Now, so here's how I run this. Here's how I would run a put credit spread business. So the capital for this position is what? Everybody agree? How much capital am I putting up to do one put credit spread for $1.25? How much capital am I putting in my TradeStation account? Well, yeah, Mark's not wrong at $1,000, but it's really $875. The total cost of the credit spread, the risk, minus the credit. Now, so here's how I would do it. So what I would do is, I'm not going to try to make the whole credit, right? What I'm going to do is try to make a percentage of the credit. So I do it this way. My plan is to make 10%, let's just say 10% of the margin or risk. So if I want to make 10% on this trade for one contract, what is that? How much is 10%? If I want to make 10% on one contract, what is that? What is that? 10% of 875. It's not a trick question. 8750, right? You guys got it. So let's round that for math purposes. I'm looking to make about $90. You agree? So if I sell it on the good side, so if I sell it for $1.25 credit, and I'm looking to make 90, where would I put my order in with TradeStation to buy it back for a profit? Tell me, what order should I put in the TradeStation to buy it back? I sold it for $1.25 credit. I'm going to buy it back at, if I'm trying to make 90, I'm going to buy it back at what? What price? So what's $1.25 credit I sold it for? And that credit will reduce. Take off 90 from there. And what's my answer? So if we take, so you say, Dan, how are you doing this? I'm taking 125 minus 90 would be 35 cents. So I'd have I'd put in a order, a GTC, good till cancel order at TradeStation to buy back the put credit spread at 35. I could pay 40 or whatever, but I'm looking to make somewhere around 8 to 10%. So whether I buy it back at 35 cents or 40. Does everybody get that? And I leave that in the whole time. That's called a good till cancel order. Everybody understand that? So we've got the profit covered. Now, that's the easy part. But then I'm going to put an OCO order in. One cancels the other. In other words, so I can totally automate this. Right? I can say, look, I'm going to have an order in to buy this back. I'd probably put 40 cents in. Buy it back at 40 cents, and I'd make probably 8% or more. Now, what if it goes against me? Now think about this for a second. This isn't testing your options knowledge because it's more this, but this is the key here. So if you're making, let's say we do these put credit spreads every week, these 36-day credit spreads, we're looking to make for every one contract we're looking to make about $85 or $90 for every 875, right? So that's about 8 to 10%. So if you're looking on the good ones, and again, I'm just focusing on one contract. If I'm looking to make $90, could I afford to lose 5 times that when I lose? What do you think? Yes or no? If I'm making on a good week or a good month 8 to 10, could I afford to lose 4 or 5 times that? No, it's not going to be great for the business. So let's go the other way. So I have an order to buy it back for 35 cents. If it goes against me, meaning if I sold it for $1.25 credit and it goes up, right? Up. And that's what would happen on the downside. I'm going to have an order in to buy it back, usually somewhere at 1.5 to 2 times my profit target. So let's just say, let's make this easy, right? Because I want to let the probabilities work. Let's just say, so let's go through this together. I sell it for $1.25 credit. I'm looking to make 10% off my risk, which is $8.75. We said about $90. We said we'd have an order in to pay 35 or 40 cent debit to buy it back. Now, if it goes against me, I said I don't want to lose more than 2 times my profit target. So if my profit target is $90 and I don't want to lose 2 times 90, I don't want to lose more than 2 times my profit target of 90. 2 times 90 is 180, right? I don't want to lose twice my profit target. So if I'm looking to make 90, twice 90 is 180. Where should I have my order in at TradeStation to buy back this credit spread that I sold it for 1.25? Where am I going to have a bid to buy this back at? 125 plus 180 be about $3.05. $3. Did everybody see that? This is a 10-point spread. It could go to 10. I'm not going to let it go to 10, right? I'd have an order in or an alert when it gets around $3. Does that make sense? Very simple risk management. So you don't have to have a PhD in gamma or a Oxford certificate in theta or the Greeks. This is called simple risk management. Agree? And if you can stick with this, that your losses, and that's the problem. Most of you that have done, it means you have to win more than 66% of your trades, right? And we're doing an 80% probability iron condor, so you're generally going to. But the key is the problem that most people have putting this into practice. I can tell you because I work in mentoring with people on live trades the last 15 years, is number one, do you think people are good at staying disciplined and putting these trades on every week? Do you think people are disciplined and would put this on every week? You're absolutely right, Mark. No, and Bart, people aren't. They're not disciplined people. And number two, are people going to be disciplined if we say you get out at 10%, but when it's going against you, you never lose more than 1.5, 2 times? What happens is, what do most people do to avoid a loss? Not pay attention to it, right? Or what do you always do when a trade's going against you? What do we all do? We ignore it or we hope it comes back. And so, again, this simple risk management thoughts, which is very common sense, if you actually applied it, would turn your life around in the credit spread business, because you're determined. This is a numbers game. This is a probability game, right? And to win long term, you have to play on a regular basis to have the probabilities work for you. And then when it goes against you, you have to, as Barney Fife from Mayberry what was that? Mayberry RF, whatever that was. You have to be very disciplined and get out at the right time. All right. Now let's talk a little bit about put insurance for black swans. Does anybody know what a black swan is? It's a black swan. Rick says, what percentage of time will you hit your stops? Or in other words, what is your probability of a win when you lose the stop loss instead of taking it to expiration? I get that depends on the market, but I think this is a very, it's very difficult to go to expiration, and if we had more time, I could go over more of that, but I don't want to be until expiration and keep it on. But anyways, this is a good way of doing. I don't have time to get into all the different things of it. But even if you wanted to hold it to expiration and make the whole credit, that's fine. But the bottom line is you cannot be losing. When you do lose, you can't be losing 5 times what you're making. That's really the big issue. All right, so let's define a black swan. How about let's define a black swan? How about a 10% move? You agree? Let's say 10%. Now, the question is, and let's even call it a 10% move in one day, right? Because a 10% move, like a typical 10% correction, we've had a few 7% moves or 8% moves in the last couple of years, but a 10% correction may take 3 months, right? Or 4 months. Which would be worse on a put credit spread? A 10% move over 4 months or a 10% move in one day? What do you think? What would be worse for your put credit spread? One day. So what I'm going to give you right now is just a few thoughts on using puts for insurance, for black swans, or just insurance. And really, it has to do with, I could get I don't know anything about military or guns, but I could get, for military, the top machine gun in the world. The most beautiful, most effective machine gun that can handle mud or whatever. But if it's in the wrong hands, right, someone who doesn't know how to use it, it's kind of useless. Do you agree? Right? If you have a machine gun in, the wrong hands, it doesn't do any good. And so to me, when you throw out a statement that you can buy puts and that will solve all of your life's problems, do you think there's more to it? Do you think there's something to do with, you think there's more to it than that? There is. So I'm just going to explain a couple quick thoughts for you to wrap your arms around. So here's an example I looked at today, April 20th, SPX. I'm looking at buying one May 26, 2080 put at $3.40 with SPX was at 23.46 at the time. You with me? SPX was at 23.46, and I was looking at buying a 2080 put 36 days out. That's 266 points out of the money with 36 days to go. Does everybody see what I'm saying here? So I'm buying my expiration is 36 days out. I'm buying a 2080 put, which is 266 points out of the money with 36 days to go. Now, in this graph here, because the put is so far out of the money, I couldn't even get the graph to go that far. I can only get the graph to go that far on the left to 2170. My put's another 100 points down. But what I want you to see is, here's what I want you to focus on. At least you get an idea. You see the red graph there? Everybody see the red graph there? And you can see purple. Are you seeing those colors? Here's the purple graph. That's the graph the day I put it on. That's how the graph looks the day I'm looking at it. This graph here is your expiration graph of the long put, because you can see here, this is kind of your zero line. So there are two different graphs. What I'm focusing in, I call this the T+0 graph, right? And I think every brokerage firm will have them, right? A picture of what the graph looks like the day you're looking at it, and then it'll have a picture of a graph of how it looks at expiration. Is everybody familiar with that? That there should be an expiration graph how your trade looks at expiration, and how your trade looks today. You see the difference there? So the purple graph would be how that long put looks today. That's more important to me than how that put looks at expiration. It doesn't matter to me what the put looks like at expiration. It matters to me what that put looks like today. So the red being 2346, can you see the purple line showing you? So the purple line is going to be right at the T+0 line and going up. Nothing's below the 0 line. So does that purple line, does that let you see that the use of the long put today, 36-day out, I'm buying a 36-day expiration. If I buy that put today and the market goes down 10% tomorrow, will that put help me? Yes or no? You see how the purple graph is all above 0 line and it does well? So if I buy the put today, a 5 delta put, 266 points out of the money, and SPX goes down today, will it help me? Everybody agrees yes, because the purple line is all above 0. You with me? That's clear. So we're talking about a 36-day put. I put it on today, the first day. So the first day I put it on, my deltas are short 4.54. I'm short some deltas. And you can look at delta as like stock equivalent. If I'm short 4 deltas and we go down 1 point in SPX, I make $4. If I'm short 4 deltas and SPX goes down 10 points, 10 times 4, I'd make about $40. If I'm short 4 deltas and SPX goes down $20, 20 times 4, I'd make about $80. Now, things will change. Your deltas will change as a result of your gamma, but that gives you a rough idea. Now, the theta is negative. It says negative 21.95. That's a theoretical number, but it's just saying I'm buying an option. And every day that SPX doesn't look like it's going down much, that $3.40 I pay is going to decay at a certain pace. And this is saying at a $340 put is going to decay the first day at about 21 bucks worth, right? So does everybody at least, before we go on here, at least understand what I'm doing here? Anybody not want me to explain it? I just want to make sure we're on the same page. We're looking today at buying a 5 delta put for some insurance on any position. It cost me $340. All right. Now, so all I'm doing is I'm looking at buying a 5 delta put. Why am I saying a 5 delta put? I'm just saying a way out of the money put. Obviously, if I knew it was going down 10% tomorrow, I would not buy a 5 delta put, right? If I knew it was going down tomorrow, I would, again, if I had tomorrow's newspaper, I'd be fine. But I'm saying if I have iron condors on or a long stock or whatever, and I just want a little bit of insurance to soften the downside a little bit, a 5 delta put, remember, a 5 delta put only has a 5% probability of going through my long strike of 2080 in the next 36 days. So it's not a high probability. So I've got to know how to use this put, right? So I buy this put for 340 today, and that purple graph is the graph. I'm looking at the graph called the T+0 graph of how the graph looks the day I put it on. And you can see it's all above 0 as we go down, that purple graph. Now, let's go to the next graph, the next thing. This is a picture, again, looking at the purple line of how this 36-day put would look 7 days in the future. And you could see we put it on at 23.46. So look where the red is, and you look at the purple there. Are we going under the 0 line? Yes or no? Are we going under the 0 line in 7 days? Are we going under the 0 line in 7 days? The answer is yes. So if you look here, right, that's the 0 line, right? And if you look here, this is the 0 line. So is the purple line under the zero line? Is the purple line under the zero line? Is the purple line under the zero line? Absolutely. At 2346, right? From 2346 to about 2320, it's under the zero line. So in the next 7 days, if we go to 2320, 7 days from now, unless the volatility goes up a lot, again, I didn't raise the volatility here, but I'm not making any money. So as time goes on, there's less likelihood we're going to go down 200 and some points for my out of the money put to do anything. Now, let's go 14 days in the future. So 14 days in the future from where we put it on at 2346, here we are 14 days in the future. We're under the zero line all the way. This is 2280 here. So that's almost 60 points. So because in 14 days, if we haven't moved much, it's a very low probability we're going to go down all that way. Does everybody get the idea what's going on here? There's limitations. You got to be careful with the put you're buying. And I'm going to give you a little guideline that'll help you. Yeah, time decay. And if you look here, here's your, again, this was a 56-day put. Well, here we are, especially if it doesn't move much at all, in 3 weeks of a 56-day put, you can see here's the zero line. And look at this. We need SPX to just about collapse, right? Here we are, 2230, which is 110 points lower than where we put it on. You need a huge move. So let me give you a little bit of something to just put away on your coffee table. When you buy an out of the money put for some type of insurance, what I want you to think about is, and here's just a guideline. I didn't develop this in a lab at MIT. MIT wouldn't let me in the school. But I want you to, the put is only going to help you for 20% of the duration. So let's go over this. So if I have a 10-day put, I buy a 10-day out of the money put, the most value of that to me is in the first 2 days, 20% of 10. If I buy a put with an expiration 20 days from now, the most value of that put is the first 4 days. If I buy a put 40 days from expiration, the most value of that put is the first 8 days. You hearing what I'm saying? After that, okay, once it gets to that kind of 20% mark, what I do is I'll roll it out another month. I'll roll it out another month. So I think that's just, again, we could spend a lot of time on this, but that's an important principle of long puts, because I've seen people with long puts and the market cranks, really goes down a lot and they don't make any money because too much time has passed. Right? Something to put in your pipe and save it for a rainy day. All right. So let's finish off with a couple strategies that have been very good over the last 3-4 years, phenomenal in a neutral to bullish market, even though they can do well in a sideways to a little bit down also. Now, so this has been a good strategy in our community over the last four years. We have classes on it. You can check our site. But here's the trade. It's an at-the-money broken wing butterfly. And let me explain what that means. This is an at-the-money broken wing butterfly. I would call it an iron butterfly. But so here's what it is. SPX is at 2346 today. I go in and sell one 2345 call. Again, I'm 36 days from expiration. You could do it 30 days from expiration. It's fine. So I'm selling the 23.45 call and the 23.45 put. What is that called? Where you sell an at-the-money call and an at-the-money put. What kind of strategy is that called? So the foundation of a broken wing or any butterfly is I'm selling the straddle. You with me? I'm selling an at-the-money call and an at-the-money put. And then my long options are strictly for hedges, right? And so in this case, I'm buying the 23.85 calls, 40 points up, and I'm buying the 22.95 puts, 50 points down. So I'm selling the at-the-money call, the at-the-money put. I'm buying the 23.85 calls, 40 points up. I'm buying the 22.95 puts, 50 points down. And you can see my upside, the width of my call credit spread, right? I'm selling the 23.45 calls, buying the 23.85s. It's a 40 wide call credit spread. I'm doing a 50 wide put credit spread. So my downside risk is going to be much greater than my upside risk. Why? Because my call side is narrower than my put side. So the position deltas of this trade, the margin, this would be about $1,540 to do one contract. My upside risk is $540. I'd call this a 40-50. Dan, what does that mean, 40-50? The width of my call spread is 40. The width of my put spread is 50. The position deltas here, I'm short 4 deltas for one contract. So if I did it 10 contracts, I'd be short 10 times 4 is 40. 4 deltas short, a gamma of short 0.10, theta of 10, it's positive theta. What does that mean, positive theta? I'm selling the at-the-money call and at-the-money put. They have more time premium in them, so they're going to decay faster than the more out-of-the-money 23.85 or 22.95 puts. So when you're selling at the monies, they're going to decay quicker than the out-of-the-money options. The Vega of minus 77 means that, again, I'm selling the at-the-money call and put. I'm selling more time. And volatility measures the time premium part of an option. So as the volatility goes down, since I'm selling more time premium than I'm buying, I'll do better when volatility contracts than when it expands. When volatility expands, usually when the market's going down, again, I'm selling the options with more time premium. I'm buying the options with less time premium. So when the option volatility or VIX increases, I lose from volatility because this time premium expands more in my short options than I make in my longs. Why less risk on the upside? Because the call credit spread is only 40 wide on the upside and it's 50 wide on the downside. So your risk in a credit spread is you look at the width of the spread. And since we're wider on the put credit spread, we're going to have more risk on the downside. Now, so basically, this is a short Vega trade. We're still a few delta short starting out. But in a neutral to up market, which we've had most of the last 4 years, and again, this is the T+0 graph, the graph at expiration. So it's pretty flat line. If this is the price of the underlying, this is the expiration graph. So this is a decent, we've recently done a class on butterflies, but we'll have a free webinar on talking about butterflies a bit next Wednesday. Which we talked about at the beginning. You can just get that information on our site. But anyways, this is a broken wing at the money butterfly. So it's positive theta. That's what makes it an income trade because my short options are going to decay quicker than my longs. Now, so Stan said, Dan, instead of doing it 40 wide versus 50 wide, what if I did a 50-50 fly? What if I did it balanced? he's saying you can collect more premium. Why limit your profit? Well, the problem is if I did a balanced butterfly in here, it's going to make me a lot more delta short. So if the market goes up, a balanced butterfly is going to be sometimes double the deltas, the short deltas, than a unbalanced butterfly. And that's going to be problematic as the market goes up, right? And then Mark said for a non-broken wing butterfly, a standard equal width on the call and put side, would it be better to have a shorter time frame than 36 days? Now, again, you know my thoughts on using the word better, right? Right? Would it be better to do a 20-day butterfly than 36-day? What do you think? Could we say yes or no for a balanced butterfly, for a non-broken wing butterfly or a balanced butterfly? Would it be better to have a shorter time frame than 36 days? Would it be better? I don't think I can answer that. I could say for a 20-day butterfly, you're going to have more theta decay than a 36-day butterfly. But if it goes against me I'm going to be more delta short on a 20-day butterfly. So if the price risk goes against me, I could lose more. So there's a plus and a minus, but I don't think it would be better to have a shorter time frame. Let's see. Scott says broken wing butterflies need trend bias. Slightly, but again, we're not starting off very directional with a broken wing butterfly. The reason that you got to be careful about balanced butterflies in an index like SPX or RUT is the reason you start out more delta short than you probably want to with these things is because of the volatility skew on the in the indexes, where your out of the money puts are going to be a lot higher volatility than your out of the money calls. So your call credit spread is going to give you a lot more short deltas than the put credit spread is going to give you long deltas. You have to look at that, but there's reasons for that. And anyways, and then the last slide, this is a 36-day out of the money put broken wing butterfly. So the only thing different here is we're starting, the price was $23.45, but we're starting the butterfly 25 points lower. So we're starting with SPX at $23.45. I'm buying one $23.60 put in the money. I'm selling two $23.20 puts, 25 points out of the money on the put side. These are all puts. And buying one $7.70 put. So my margin of risk would be $13.70. Again, more. I'm starting, if you look at my position deltas, I'm only short two deltas on $1,300 of capital. So it's pretty neutral. These are pretty neutral trades, but I have less risk on the upside. Mike says, but SPX climbs wall of worry unless Trump tweeting, compared to more probability of sudden down moves. Do you adjust or close the whole trade if it goes too far one way, say 150% of credit? I mean, we make a plan. Our plan would be, I'm looking to make 10% of the margin or risk of $13.70, and I don't want to lose much more than 10% of that. And then we'd have some risk management when we would adjust along the way. But I don't go into it thinking the more likelihood upside or downside or whatever. I don't look at life like that. But anyways, that's what I would do. Now, we've already gone about an hour and 15 minutes or so. So I think what I'll do is just, if you have any questions, you can email me at dan@sheridanmentoring.com. I'd be happy to help you if you have any, we teach coaching, mentoring. That's what I do, teach people to do this with live money. But I'd encourage you, maybe Dan will be passing out or sending out the PowerPoints. Come and see those 2 free webinars in the next couple of weeks. Sign up for those. Even if you can't make it, you'll get the recording sent to you. And again, if you're reviewing the material, if you have any questions, send me an email. Be happy to help you. Work at the craft, right? This is a wonderful business. As Don and I can both attest, we've been in the options business a long time. You don't have to be rocket scientists to do it, but you have to do it, right? You have to, this is a craft. You got to do this. So folks, have a wonderful, wonderful time. It was nice spending a little bit of time with you today.